What's going on, everyone? I hope everyone's having an awesome start to their day today. I have a really cool live plan for today. We're going to be talking about an article that I found this morning to kick things off that really showcases some of the insanity that's going on in the market right now. And then from there, I'm actually going to go into a couple of trades that myself and Jordan have been looking at over the last 24 hours, which I think are actually really good opportunities. I'm going to break down exactly why I see them as really good opportunities and chat with you guys about it. On top of that, at the end, I'm going to be looking at any of the trades that you're looking at yourself. Be happy to break them down for you, share my views on it, show some data. So if you have trades that you're exploring right now or positions that you feel a little stuck in, feel free to share them in the chat, and we can go over them at the end. But the first thing that I want to talk about is what has really happened in the market with this massive influx of retail traders. So one article that I couldn't find that I did see a while ago was a question that was posed was like, how would you identify retail traders in the market, right? And if you couldn't actually see the name of who it was and Google them, how could you identify a retail trader? Well, one thing we know about the at-home trader is they typically have less capital than a fund, right? If a new trader was trading Apple, right, they would probably buy a call or 2 calls, not 50 calls. So if you're seeing a bunch of, you could probably identify retail traders by looking at how many 1 or 2 lots are traded in the market. And what this article showed was historically, the volume of 1 lots that were traded represented about 4 to 5% of the option market. And that was the way it was up until about March of last year. I saw this article back in maybe October, and it was showing that the volume of 1 lots that were traded increased from 5% of the total option volume in a couple months to 12%. Almost all, like 12% of the volume being traded is 1 lots. What that really means, in my opinion, is that retail traders are now in a position where we actually can say with confidence, they can move the market. Right? We can see these massive inefficiencies driven by these retail traders if we can see some sort of pattern in how they actually trade, right? Obviously, we all know like the Wall Street bets, yeet, buy the calls, hypothesis that they just buy a call, don't care about the cost of it, whatever. But what if there was some evidence to support that that's maybe happening? And that's when I found this article here, right? This article was super interesting, okay? So check out this graph right here. What this is showing us is over time, how has the volume of different trades gone up, right? So like for equity calls, equity puts, index calls and puts, ETF calls and puts, how has the volume for them changed? And the blue line is the equity calls. So take a look at this, right? From about March, May of last year to now, look at what has happened to the volume of calls on single name equities. It's through the roof, everyone. We have never in the history of the market seen this volume of calls being purchased. All right. What do you guys think about this? Like when I saw this, this blew my mind, right? It really went to show like how big of an impact these guys are having right now. Right. And why like selling vol has just been unreal the last little while. So this is like the major thing that I wanted to point out at the start, right? We're seeing this huge amount of volume, and this article actually goes pretty decently in depth into a couple ideas that could come out of it, right? Things that we maybe want to be cautious of. And I'll actually share that right now in the chat so that anybody who wants to take a deeper look into this article can do so. Now, the way that I'm going to be using this is I've noticed a couple of ETFs that have extremely high implied vols, and a lot of these ETFs are actually their components are extremely popular in the retail space. So the ones that I'm going to be taking a look at today are ARK, Lit, and TAN, right? And, you might be saying, well, Sean, we looked here and we see that, there's not as much volume for ETF calls, right? ETF calls are still down here, right? Well, why would you be doing it? Well, imagine that an ETF contains all stocks that are up here. Well, that's going to drive up the implied volatility for the ETF, even if the volume isn't there, because that ETF contains these stocks with high implied volatility, right? So the ones that I'm going to look at once again are ARK, Lit, and TAN, and I'm going to break down why I think each of these is a trade worth looking at, right? Each of them has a slightly different reason. The first one that I'm going to look at is ARK, right? So let's start by pulling up what actually ARK is, right? So a lot of us know it, right? It's the Disruptive Innovation Fund. It's basically the Wall Street Bets Fund. It contains all the big stocks that are super, super profitable recently, but also, super, super popular is what I meant, in the retail space. Justin, we'll chat about that when we get to TAN, because TAN is more of like a solar green energy ETF. And that definitely would have some impact on the vols there. And what you'll see is they're through the roof. So take a look at this, right? We have Tesla, Roku, Square, etc. And here's what's really interesting about this. Let's look up a couple of these and see what's going on with them, right? So if we look at Tesla, all right, let's come to the vol analyzer here. We can see, Tesla implied vols are back at really, really high levels, back above the third quantile, right? We can see here that this bump right here to 90 on the 20-day. And if we go to the earnings analyzer, we can see they have earnings coming up in about 3 weeks, right? Implied move is really high, 10%, right? Much higher than the average move and what it typically implies. And I'm going to just show you a couple of these for a second, especially what's happening around their earnings, because that's really what's behind this trade that I'm looking at. So Roku, let's take a look at Roku. Right, Roku's implying, 8.47% move. I think I have CRSP in here right now. I might need to add it. But there it is. Right, 9.65% implied move. Let's look at Square. 8.8. So do you get my point? All of the components of ARK have extremely large implied moves. For the earnings for each of these companies, they are implying a massive move. So what can we say about this, right? First of all, what we can say is when we see these high level implied moves, much higher than the average move and even the average implied move, we typically want to be selling vol on these names. But maybe there's a better way to get exposure to these implied moves than simply going equity by equity and selling it. And that is what we are going to look at for ARK, right? This is what's really driving ARK as a good trade for me. Now, in order to really wrap our heads around this, we need to understand one concept about the implied vols for an ETF, right? So let's see if this works. Okay, cool. So let's say we're looking at this ETF, right? And this ETF contains two stocks, right? Stock 1 and stock 2. Let's say stock 1 moves up 1%. Right? Let's say, by the way, this is each stock is 50% of the fund. All right? And let's say that stock 2 moves down 1%. Okay? What does the fund move, right? The ETF. Well, the ETF moves 0. All right? Now, what this tells us, right? So this is situation 1. What this tells us is when the underlying components of the ETF are uncorrelated, the volatility of the ETF is less than the individual components. When they become correlated, right? So if this had actually not gone down 1%, but had gone up 1%, well, then this wouldn't be 0. This would be 1% as well. So when we're looking at the earnings, the cool thing about earnings is all of these companies have all these components have a big implied move for ARK, right? So let's say we're looking at this thing has let's say 4 components, right? Right, it has 4 components, and this one is going to could move up or down 10%, and they could all move up or down 10%. Right? Etc. Well, the ETF is going to be pricing in about 10% vol, right, for that day, right? And this is what we're going to see over that month, this huge implied vol. But let's say this one goes up, this one goes down, this one goes up, and this one goes down. Well, all of a sudden, we're not going to realize much volatility in the actual fund itself. So take a look at this, right? The cool thing about the earnings is that these are all independent events. Just because Square goes up doesn't mean Tesla or Roku go up, right? They could all move independently of one another. They all have a high level of implied vol, and they are uncorrelated. And what I'm quickly going to do is show you that even without the earnings, these things are not correlated with each other. By going to this watch list feature here, and I'm going to show you a couple of different things. So first, I'm going to pull up all the ETFs that are in here, right? So Roku, CRSP. Right, I'm building a little watch list here. Square, TDOC, and VTA. Let's see. After NVTA, Z, and Spot, and PSTG. Okay. And now, since we're looking at earnings, I'm going to pick some of the indicators that I want to look at. Let's look at the implied earnings move, the average implied earnings move, and the average move. Is the market closed on the 18th? I'm actually not sure. Anyone have an answer there for Justin? But let's take a look at this. Ready? When I click run here, a couple things come up. One, all those tickers populate in this new little scanner here, along with the different indicators that I wanted to look at. So I have the implied earnings move for the upcoming event here. I have the average implied move here. And I have the average move that is realized on earnings right here for the companies. Below that, I have a correlation matrix for all of these companies. How correlated are these companies to one another? How do they move relative to one another? And you can basically see that none of these stocks are extremely correlated with one another. The most correlated ones I'm seeing are Square and Zoom, right? Besides that, right, you can tell basically by the shade, right? The darker the shade, right? You can see these ones that are like a 1 are in extremely dark blue, and these ones that are like a 0.2 or a 0.17 are in extremely light blue. But these ones that are the 1 are obviously, Square and Square, right? That's how these correlation matrix work. So off the bat, we can see, there's how would I put it? There's really no correlation between these things. Just because one goes up doesn't mean the other one goes up. We can see they all have these huge implied moves, but these are all components of ARK. So what we can do is come back to the volatility insights, and let's actually see how this has impacted ARK recently. Okay, so 30-day implied vol at 55, right? Stock's realizing some volatility still, 1.93%. But what's the 90-day looking like here, right? Let's pull this up. Let's have a look at the volatility over time. So we can see that 90-day vols are also through the roof, right? 90-day vols are at 53%. Absolutely crazy. Let's actually see here, right? Stocks just ripped up, right? But we had that small downtick now. Let's take a look at the term structure here quick. Or actually, we'll look at the vol cone. So take a look at this. All right, let's take off the maximum in here. We can see that the the current level of implied volatility, we're back well above the third quantile, meaning we are seeing a level of implied volatility across the term structure much, much higher than what we see on average. You can think of it like this. This third quantile line, below it, right on the y-axis here, we have implied volatility, and then we have days to expiration on the bottom here. Below this line is what we see for implied volatility for ARK 75% of the time. So we are in a range of volatility, implied volatility for it, that we see only 25% of the time in the last 2 years. And we're pretty high up there, right? This line's about 45. This line's at 55, right? 10 points higher than the 75% line. Now, obviously the max is higher than that, right? The max is, we've seen an implied vol of, 90 at one point for the 60 days, 100 for the 30 days, but these are COVID level volatilities. We shouldn't be seeing that right now. So I think a lot of this for the 60-day is the fact that the individual components have an extremely high level of volatility. And the reason they have this high level of volatility is they all have these huge earnings moves implied. So what we can do here is we can get exposure to that high level of implied volatility of the components of ARK without the individual equity risk of selling vol around the components by selling volatility around ARK. So the trade that I would maybe look at is something like this. Let's see here. We look at maybe I'd go to March and I'd probably look at selling like a Delta 40 Strangle. So I'd probably do this. Sorry guys, having a little bit of lag here. I hope that I'm not disconnecting. All right. Delta 40, that's a 152. 152.96 strike. That's whack. I can't believe they have that. 137.96. All right, let's have a look at this. I'd maybe look at doing something like this, right? ARK is currently trading at 140. And as long as ARK stays between 172 and 117 going into March, we will be, extremely profitable. But realistically, this is what we're hoping to happen, right? We are not, having a directional bias on this. We are trading the level of implied volatility. All right, we're expecting that as these earnings come through, this volatility is going to drop off. And because these events are uncorrelated, some will go up, some will go down. We won't realize a huge move in the fund, and we might see something like this happen. Right, come to the vol adjuster here. Right, we were saying that if we go back to the terminal, implied volatility looks like it could come down maybe 13. Let's see, so that'd be 10, maybe 15 points by March. Right, so let's say somewhere in between we see a drop off of about 12 points. Let's see what that would look like. Right, if we saw vol drop 12 points here, we'd be up huge. Right, we'd be up absolutely huge on this position. Let's just go down to a one lot here, make it a little cleaner. Right, obviously we have this max risk, but or this undefined risk, but what we would do for that is we would basically say, okay, well, what happens to our position if the stock drops 10%, 20%? And we would ask ourselves that and say, where are we wrong? So a couple places where we're wrong is if this thing trends in one direction, I would say 15%, right? So we're at 140, 14, 21 bucks. Yeah, so if we start to see it get out here, I would say we're probably wrong, right? Or down to here. These would probably be my two get out points in terms of delta, right? Basically looking at around here. Now, what about in terms of volatility? Well, we're still a little bit far away from these earnings events. So a question we need to ask ourselves is, as we move into them, do we expect implied volatility to increase for these companies even more? And that's something that I'm still really trying to work through is, should I be putting this position on right this second? Should I be scaling in over time if things get better, or more desirable to be short vol here. Because, coming back to this graph here, as we approach the events, are we going to be seeing a crazy increase in demand for these call options, for example? Right? Single name call options are through the roof, and we're approaching the earnings for these companies. We could totally see that happen, right? We could totally see that happen. So that's what I'm kind of thinking. I might, scale in a bit now. And then as we approach these events, get much closer to them, they're still a couple of weeks out for the most part. I'll probably scale in more because I think we will actually see these levels of implied move for the earnings events for these companies continue to rise moving into the event, making the implied vol for ARK in the very short term continue to increase. Now, in terms of expiration, I would be trading the March. Remember, what I really want exposure to here is that level of implied volatility. It's way too high. I want a lot of Vega exposure so that when this drops back down, I get paid, right? I don't really care too much about the day-to-day movement of the stock, the day-to-day realized vol, as long as it's not through the roof. But any questions about this trade, guys? I think that, that's really what I'd be looking to do here. If you have any questions, I'd be happy to continue to go over them. But if not, I'm going to quickly show you a couple of the other ETFs that have caught my eye recently, namely LIT and TAN. That's right, guys. I'm sure a lot of you know, we had to cut LIT recently. It was, it was moving against us too brutally, but I think the opportunity's back on the table here. Stanzen, what's going on, man? Hope you're having a good morning. All right. Is there a margin efficient way to put on the Strangle? You'd have to have some sort of defined risk, right? I guess in the long term, right? You'd be paying a lot for wings on this thing, right? I think that if you wanted to do this, the way to do it is to throw on the straddle. There's nothing. Exactly, which are overpriced. I don't think there's any other way to do it really. But I'll do some digging around and I'll share some stuff with you in the group after. So Stanzen saying, are you confident scaling in because it's an ETF? Would I be confident if it was a stock? So Stanzen, something I talked about little before, let's see if it's still open here, is look at this mess. This looks like blood on the walls or something. I should have used a different color. It looks awful. But Stanzen, what I was talking about before was basically because it's an ETF, right? It can make money because the reason I like this ETF is it gives me exposure to all these stocks that have high implied volatility and a high implied move for earnings without giving me that single name equity risk, right? In the end of the day, I can, if I sell vol on Tesla and Tesla has a big move to the upside, well, I'm going to get hurt. But if I sell vol on ARK and Tesla has a big move to the upside and Square has a big move to the downside, well, it breaks even on the fund, assuming they're equally weighted. So what I did was I came over here and I looked at the, I built out a little watch list of them, and you can see that these equities that are within ARK are uncorrelated with one another. They don't move together, right? And what we could do as well, I won't do it right now. It'd take too much time, but I could go into my earnings analyzer, look at each individual company, right? So let's say, I pull up Tesla, and I could look at what the straddle P&L has been, what the the earnings distribution has been for each company. So do we typically see down moves or up moves? And assuming that the graphs look different for all of them and we're not seeing a commonality between them, well, then it would give me a lot of confidence on this play. So reason I would be looking to scale in is something I talked about even earlier, which is call volumes at all-time highs for equities, individual equities. Meaning, as we move into earnings, I'm thinking there's a chance that we see these levels of implied vol increase pre-event because, well, people are buying calls. Call volume is just like literally at levels that are just unprecedented. And guys, I hope this really, really emphasizes for everybody on this live, right? Let's talk about this for a second. There are 28 people on this live. That's it. Nobody's looking at this type of stuff, right? This is, we're having a really interesting conversation here. And I'd actually love for some of the silent watchers here to share their opinions, because this should be exciting, right? I know that I'm moving a little quick. If you need me to slow down or ask questions, or answer questions, please, let's do it. But this just goes to show you, like, there's big opportunity right now, right? There's really big opportunity out there. It exists in single name equities. It exists in funds, ETFs, but we need to be able to price the asset because there's a whole whackload of people, right? There's a whole whackload of people out there who can't price the asset. Imagine selling insurance to someone who doesn't care how much it costs. If they want it, they want it. They'll pay whatever. And you can come in and evaluate the price that they're paying and say, should I be selling this to them? That's the exact situation that we're in on a lot of these trades right now. And it's unbelievable, guys, right? So let's dig deep. Let's chat about it, because this could be the best year ever. This could be like the best year ever. So let's talk about Lit right now, right? So as a lot of you know, Lit was one that absolutely burned us, recently, but we made a really, really big executive decision a while ago, and we completely cut the position. It was rallying against us really brutally, right? You could see this huge uptick in realized vol from 27 to 40. And that is where we were short vol on this rally up. It hurt, right? But we made a really good trade. We were actually out a little bit before 40. We were out maybe around like 35. But here's the thing. Vols continued to rally, right? We are back to basically COVID highs. Right? We were basically back to COVID highs on this thing. Vols have started to taper off. Realized vol has flatlined. Now is looking like a time to get back in. Think about what we did. We got into the trade because we thought that the implied volatility level was too high. And then it kept skyrocketing, right? After we got in, it kept moving up. Realized vol kept going up as well. Stock was rallying to all-time highs. And now we have got that tapering off. Oh, sorry, I was just looking at Irving's question there. Irving, I'll get to your question in a second if that's okay with you. So now is looking like a decent time to get back in, right? We're looking at a very similar trade to what we're doing on ARK, where we're looking at selling maybe a little bit further out maybe the Junes or something. But as you can see, right, if we pull up this vol cone, far dated vol is literally 5 points below the highest we've seen in the last 2 years. It's absolutely insane what's being implied here. Right? Lit vol's just through the roof. It's like the market can't sustain this forever. Right? The only issue we would have is if this thing continues to rally, right, move in one direction, we'd keep hedging. If realized vol picks back up, we'd obviously be in a tricky spot again. But my whole point is this. One of the characteristics about volatility is this. So one of the characteristics about volatility is that it clusters. And the second one is that volatility mean reverts. Okay? So what do I mean by this? If you were to look at volatility over time, it looks like this. Okay? When volatility is low, it stays low. So if today the stock moves 1%, the most likely move for tomorrow is 1%. If today the stock moves 5%, the most likely move for tomorrow is 5%. What happened to Lit was we saw this happen. And then vol stayed high. But now what I'm seeing is that vol is coming back down, which leads me to believe that we could see low volatility moving forward. Right? It's just some of the characteristics of volatility. So I'm starting to think that implied vol tapered off, right? We saw a 1.4% move today. Right? If we zoom in here, we can see that things have flatlined more or less for the last few days. Implied vol continued to rally up though. Right? That far dated vol looking super, juicy, very expensive. I'd be looking to maybe sell that there, betting on it coming down to at least, like, look at the third quantile here, guys. Like, we're trading at, take this in, 90-day vol is 60. 75% of the time, it's below 35. Let's say we're wrong here, and this thing's going to keep going up. Where the hell can it go? To 70? To 66? All right, let's stress this, all right? Let's throw on this trade here, and let's see what happens in each situation, okay? Let's say we throw on lit. We come here. What do we got here? Okay, let's just go throw on the new trade here. Let's say we look at the Julys. We sell a Delta 40 Strangle. All right, let's come here. Delta 40. So it was the call at 83. Sorry guys, just give me a second here. My eyes are not adjusting to this well. And then on this side, we're going to come to the Delta 40 again. All right, we're doing a Strangle here, by the way, guys. So we're going to be doing the 69 strike for the put. All right, let's take a look at this. All right, so let's say we throw this on. Okay, we are at inception, right? Stock's trading at 70 bucks. All right, so we're right here. At inception, we have very little delta. Our main exposure is Vega here, right? You see this? We have our Vega exposure here, negative 386. That's really what drives our P&L. So let's say this stock's implied volatility goes to all-time highs, which would represent about a 7-point increase in implied volatility. So let's come down here. Let's see what happens if implied vol continues to go up, right? It goes up 7 points. And let's say we just do a one lot, right? Just relatable to everyone, right? All things held equal, we would be down 270 bucks, right? That's what a 7-point increase in vol would do to us, putting us at 2-year highs for volatility, COVID level volatility for lit. Now let's see what the other side could look like. Let's say volatility comes down to what we see 75% of the time, right? Not even the average, just the range that we see, at least, most often. It's basically like saying, what if we move from over here just back into this body somewhere? Well, we would go from 60 to 35, so it would be a 25-point drop in vol. So let's bring this back to 0. Now, let's drop vol 25 points. Look at what just happened. I'm going to do that one more time. Look at what happens here. Vol drops 25 points. We stand to potentially make $1,000 per lot. All things held equal. Do you see? There's not, how much room is there really for this thing to increase in vol still? There's not that much. We're at the top. And what do we know about vol? It mean reverts. So we can take a bet on this mean reversion. And potentially stand to make a lot of money here if we are correct. Now, where we are wrong is probably if we push to new all-time highs on implied vol. Right? It's when we push to new all-time highs on implied vol. Or if this thing just continues to realize a lot of volatility and rips in one direction, right? That is what happened to us last time, right? If we come back here, we look at the 3-month, we were basically in the position around here. And this rally right here, we got burned on. We got burned on it. Realized vol picked up. Implied vol kept going up. We were just on the wrong side. We were potentially just too early on this. We made the great move of cutting it. And now it's looking like a decent time to get back into this position. A little bit more research going to go into it on our side. Off the stream, obviously, don't have forever to sit through all of our research. But I think it looks pretty juicy. Stanzen was asking, Bronze Academy, is that a good read? So Stanzen, Bronze Academy is the entry-level education provided with Predicting Alpha, right? So when you buy this terminal, most people come into this and go, what the hell is this thing? How do I use this? Bronze Academy teaches you the basics of volatility, taking a view on volatility, and how to use the terminal to find something worth expressing a view on. And then there's obviously a ton more stuff after that. Should we be positive delta for this because EV and stuff surrounding new legislations? So that would really be up to you, Justin. Don't forget that this thing's had a huge rally in the last month, right? Ever since the Joe Biden in office, things gone to the moon. Isn't the market sort of pricing this in already? Maybe, right? You know, it's one of those things. It's like I don't know anybody who's not thinking that. Right? Maybe you can lean a little positive delta, but I wouldn't be thinking this thing's going to blow out the top again just because Joe Biden's in office. It looks like the market's pricing in that this thing's going to be extremely, the market's pricing in this thing's going up. This thing's been rallying like crazy, right? Think about it. From November 9th or whenever around the November 5th, it's up almost 50%, right? It's not like the market's saying this thing's not going up. So that is the second trade I wanted to look at today. And for you guys, I normally want to cut this thing at 11, but we're going to take a look at one more. All right. And if you guys have any trades, you know what, I'll be willing to, stay on this for at least another 25 minutes or so. So if you have trades you want me to look at as well, drop them in the chat. And guys, if you found this valuable, I put a lot of time trying to make this live as good as possible. Please drop a like on this video. And if you don't mind, all I ask in return is you hit the subscribe button. It makes me smile when I see that a couple new people subscribed after doing these lives. So it would mean a lot. Thanks a lot. SNE. Yeah, Ronald, we can definitely take a look at that right after this. Guys, when you're doing this, do you mind just sharing what trade you're looking at? So for example, Tony, I like the way you did it, right? You want to do like a butterfly on GOEV for the May expiry. If you just want to, let me know, what exactly you're looking to put together there and why. And also, before you do all that work, let me make sure. So here's the one thing, Tony, we actually don't have that in the terminal. Given how many contracts and the cost of the trade, it's probably just, it sounds like it's a pretty illiquid name. One of the things that we look at for this terminal right now is we look at just the basically top 1,000 liquid names on the US exchange. Okay, so let's talk about the last trade of the day. Pranav, you're funny. We're looking at TAN here. So TAN ripping to the all-time highs again, but we can also see, right, let's come over here to relative value for a second. Let's just pull it up on the bigger screen. We're just going to start off by looking at 10 90-day implied volatility. And check this out. We are back to the highs, baby. Look at this. Things just ripping to the moon again. Implied vols, all-time highs. If we plot the realized vols on it, we can see that realized vol was picking up, but it is still below the implied vols now. But the realized vol has started to taper off. Right? Remember, we always want to look at this. Sorry. Ugh, gotta sneeze. Sorry about that. I had to sneeze. Didn't happen though. Right? Remember, volatility clusters. If we see a 5% move, then we see a 5% move. You know, we're likely to see another 5% move. But let's say we see it come down, and the next day we get a 1% move. Well, then after that, we're probably going to see another 1% move. So coming back to the vol insights here, we're seeing no move in TAN right now. We're likely to see no move tomorrow. It's the most likely scenario, especially since there's no events or anything for TAN. Right? It's not like TAN has an earnings tomorrow or something like that. So coming back to the relative value here, we see the implied vol tapering off at the top here, realized vol tapering off, looking like a decent time to get in. I'd probably be doing the strangle again here. And remember, the reason why I would be doing that is, you know, it gives me the most exposure to that Vega, right? That far dated strangle, most sensitivity to the implied volatility. And that's really what I'd be looking at to put on here. If you need to make it more cash efficient, you would be looking at doing the Iron Condor. However, you want to make sure that you're not paying too much for those wings. Something you'll note is your break-evens get tighter when you buy those wings, right? You're collecting less premium for that strangle or straddle that you're selling, which means that your break-evens are tighter. Your range in which you're correct gets smaller. Right? Of course, you define your risk, though, more margin efficient, but you know what I mean? There's different ways you could take advantage of, what's going on there, but I think that that's just the most efficient way. If you can't do that, you could maybe do something with a calendar. There's a couple different things you could do maybe, but you really want to express your view correctly, right? So if you want, Stanzen, shoot me an email, and I will, and let me know sort of some of the requirements or constraints that you're playing with, and I will try to help you structure something out. I'll type my email in the chat here. Yeah, you can feel free to just shoot me a message. So yeah, this is pretty similar to the other ones. I'm not going to go crazy in depth. I feel like sometimes I'm talking in circles. I guess that kind of is what happens on stream sometimes. I'm still trying to get good at this. But, implied vol is through the roof, realized vol tapering off, sell vol. The answer is just sell vol, right? So Ron, you're looking at SNE. What's going on here, man? Implied vol at 33, forecast at 23, right? 34 and 23. Okay, that's a good spread. Let's go here and take a look at some of the sentiment around this thing. Retail sentiment, crazy. Option activity is through the roof on this thing, man. What the hell's going on here? Reveals air peak drone. Okay. So they're releasing a drone. Ronnie, you have any idea what's going on here? A concept car? It's being tested on public roads. Okay. Electric car concept. Okay. And you think that's what's driving all this vol? All this implied vol? Like, it's through the roof, guys. This is pretty crazy. The one thing I'll say is, like, it's not like the level is, like, super high. If we look at the vol cone here, it's nothing too crazy. 30-day vol is the peak here, but it's kind of leading me to believe that that's probably when they are having their earnings. Right, so we can see their earnings falls into that 30-day. Pretty huge implied move there. I'd probably be short vol going into this event too, honestly. Ronnie, this is very similar to the Netflix one. You got to be aware of this earnings event coming up in a couple weeks. You think they're doing some more announcements? Okay. Yeah, I honestly, guys, like, This is a tricky one, right? I would actually say that non-event, like let's look at the non-event vol, right? Non-event vol is actually trading at 26, right? This is that value of that term structure here that we have. We actually extract the non-event volatility. Right? It's trading at 26, right? Markets, we're forecasting 23 for the non-event. Well, there's not much edge here in reality. Right? I'm actually thinking there's no edge there's very, very little edge to be short vol here. Something that is kind of cool though is there's this call skew. I'm always a fan of the call skew. Maybe there's something we can take advantage of here. Let's go see what we can get if we structure this out. All right, if we look at the 30-day option, yeah, PlayStation sales, that'd be one thing that could surprise. Right, let's say we look at the Feb 19 here. Let's structure out a 132 fly and see what we get. Straddle's going for about $9, $8. So let's say we do a unbalanced fly on the call side. All right, first strike we'll put at 105. And we're going to go up maybe 10. We'll go to 1, or should we go up 8? Maybe we'll go up 8, and then we'll go up another 4. Oh, that's not trading. Okay, so we'll go up 10. So 115. And then we'll go up another 5 to 120. Let's see what this thing looks like. All right, we can get about a 1 to 4 risk reward. Betting on the stock rallying if you're bullish on this thing. We could probably also do just a simple, slightly out of the money vertical, maybe right here. All right, buy is this the right? Delta 20. I'd probably go here maybe. Buy and vertical. 110, 115. Right, maybe something like that. You're getting about 1 to 4 again on the vertical here. This is probably actually what I would look to put on if you're bullish on this, right? As long as the stock goes above 111 more or less, you're going to be making some pretty good money pretty damn quickly. So yeah, if you're bullish, this is probably what I'd look to put on. Looks like a pretty good trade. And you get to see the earnings event. You get to see the event coming out this week. You get all the non-event vol. Remember, option volume is through the goddamn roof on this thing right now. Think about this. We have already seen 150% of the average option volume traded today. And if we take a look here, a lot of it's been calls. Lots of calls getting bought. Sort of falls in line with what we were seeing on this graph, eh? Kind of interesting. So, yeah, Ronnie, what I would maybe look to do, this will be a really interesting one for you to try and put on. Try and put on a vertical. Right? A little different than what you've been learning in the bronze material, man. But ask in the group, go try to structure this out. The 110, 115 call spread on SNE in the February expiry, the February 19th expiry. Go try and throw that on. Share a picture in the group, and I'll critique it. And also come to the Analyze tab here and try to tell me what you see. Like, how do you make money on this thing, right? What happens if volatility changes? How are you actually making money on this thing? Okay. Do we have any other trades that we want to take a look at together today? Because this has actually been a really fun session. I hope you guys got a lot out of it. Just a reminder, I'm doing this every single morning at 10:30 a.m. Eastern Standard Time. So if you found this valuable, please drop a like on it. And if you want, as Eric said before, I wasn't even thinking about this. If you want a notification when I'm going live, I sometimes go live, random times, like maybe on the weekend or something. Hit the notification bell, and you'll get the little buzz that I'm going live here. And I plan to get into actually making more video content as well for the public. A lot of my video content right now has been focused on our, the Predicting Alpha courses, Predicting Alpha live workshops. But I plan to get back into making video content for YouTube. So if you haven't subscribed, make sure to subscribe. I'm basically just trying to bring data-driven trading to everyone, right? I really can see the future of trading changing for the average person here, right? I can see, I call it the retail quant. The small guy who knows how to work with the numbers, knows how to price the assets, forecast vol, and is basically the David to the Goliath of Wall Street, right? Actually has the right tools, and the skill set to compete with the big dogs from his bedroom, right? That thing that everyone wanted with the charts, they actually maybe could get learning this type of stuff and getting access to cheap data. So thanks a lot, everyone. I hope you enjoyed the stream, and we will see you tomorrow morning. Take it easy.